Welcome back. You're watching Your World at 10 on CNBC TV 18. Now, as we've been telling you, Anil Agarwal's Vedanta Resources has decided to boldly step out of its mold of a purely mineral resources player and acquire a controlling stake in oil and gas company Cairn India. While this is a path previously taken by players such as BHP Billiton, analysts have expressed concern over Vedanta's debt levels that it will have to incur to be able to undertake an acquisition of this size and its lack of expertise in the oil and gas space. So, is Agarwal being too ambitious with this acquisition? Joining us to answer that is Anindya Mohinta, analyst at Citigroup, who joins us from London. Anindya, thank you so much for your time. Let's discuss this strategic rationale. Different analysts have put this differently. There are some that believe that most of Vedanta's existing businesses will really come of age and of adequate size in the next 3 to 5 years. And this is a good move to be able to sort of pursue additional growth. Others point out that, Vedanta's in virgin territory as far as its own history is concerned, and therefore this might seem non-synergistic. Which bucket do you sort of belong to?
I think probably the more pessimistic bucket, because as you mentioned the similarities with BHP Billiton. I think the one area that BHP is very different in, BHP built up its oil portfolio over 3 or 4 decades, going back all the way to the 60s and the 70s. And it's also which part of the capital structure BHP got into. BHP did not buy producing oil fields. They bought acreage, explored, found and built. Whereas what Vedanta is doing is simply monetizing value for Cairn Energy, which but bought the asset at least and developed it and built it. So I think depending on where you get it into these assets, I think that makes a huge difference in terms of is it a good deal or a bad deal. So BHP's entry into oil was very, very early stage, whereas what Vedanta is buying is a fully developed, and sure, you can have some more, there's always exploration upside. But it's fair to say that most of the value capture in Cairn India has already happened.
A quick follow-up to that, Anindya, would be that are you okay with its foray into oil and gas, but not very okay with the purchase of Cairn India, as you pointed out, an already built-up asset, so to speak, or are you not okay with both?
I'd say probably neither, because to be honest with you, as an analyst, I think my biggest issue at the moment is Vedanta has ongoing issues in its existing Indian operations. Where I'm sure you saw the ruling that we've had from the NC Saxena panel on the bauxite mines today. So there's very specific issues that Vedanta needs to address in its metal businesses. And if you turn the clock back to when Vedanta listed in the UK market, the key pillars of strategy for Vedanta were to simplify the holding structure, so the minorities in Hindustan Zinc and Balco to be bought out, to actually lower the assets down the cost curve from where they already were. And I think that's where most of the investor frustration seems to come from, that a lot of the promises made at the IPO stage still remain unfulfilled. So typically investors like seeing companies doing what they've promised first before moving on to different territories. So I think that's where the frustration is, that there's a lot of stuff that needs to be done first to actually get to ground zero, and then we can move on into other commodities and into other assets.
All right, that's a fair point. A pending list of top priorities, as opposed to sort of diluting your management bandwidth by diversifying into a completely virgin territory. If I may turn the phrase, in that case, the price of this transaction is just adding insult to injury, isn't it? Because many people have pointed out that at the current levels of crude, which is not cheap at all, to be paying this kind of premium to a stock that's been fully valued at that price seems to be more than just expensive.
Agreed, and I think, if you look at it from our perspective, as a house, Citigroup downgraded Cairn India in July to a hold from buy, and I think our view was it's a great company. They've done a fantastic job picking up assets from the cheap and building it into one of India's biggest oil fields. But there's a price for everything, and we think at these prices the value is pretty fully reflected. So we don't think what Vedanta is getting is a bargain in any sorts. And you can look at the Cairn Energy statement itself. Typically, I would say Cairn Energy PLC understands the value of these assets the best. They built these assets over the last decade, and their response has been, we think it was a very good deal for us. So you can't have two parties in a transaction getting a really good deal. It seems to at least to me, it's reasonably clear that Cairn Energy definitely got a very good deal in this transaction.
In fact, Cairn Energy got the better end of the deal. Do you think that there is any upside to be had at all for Vedanta? Let me quote a comment made by one of your competitors, JP Morgan, in its research report said, Vedanta shareholders will be keen to learn what hidden value they plan to extract from the business to justify paying a premium to the all-time high share price. Do you think there is any such hidden value, tongue-in-cheek?
I mean, to be, I'm sure, just to give you my own view, I'm sure JP Morgan have their own view as corporate brokers. But my sense is in any mineral asset that you buy, there's always some exploration upside, be it a mine, be it an oil field or a gas field. The question is, how much of that upside is priced in. Typically, when a company is trading at a premium to its net asset value, some of that exploration upside is already priced in. And if you look at the existing uplift that you have in terms of Cairn India's barrels per day production, so from 120,000 barrels per day to 240, that uplift is already expected by most analysts in their forecast. So I think, sure, if your question is in 20 years' time, could Vedanta double the size of this asset by investing a lot of money? I think the answer is yes, that's possible. But you can say that for pretty much any mineral asset that companies own these days. I don't think that's anything dramatically different or new.
In that case, I buy the point that who's really going to wait for 20 years for a deal like this to explain itself. What do you make of the non-compete? Again, a contentious issue here in India. Lots of people are betting on whether the regulator is going to find any objection with that non-compete, considering that Cairn doesn't have any other fields in India and really cannot offer any kind of competition over the course of the next 3 years, during which it's signed away the competition rights. Again, a justified premium, so to speak, or it's just hurting Vedanta shareholders even more?
I mean, sure. Cairn is not a stock that I personally cover, but I guess the only comment I can make is that if you look at it from Cairn's management's perspective, as you rightly point out, they don't have any other material assets. They have some, if I remember, they have some exploration assets in Nepal, but again, nothing that's sort of material compared to the Cairn India assets, what they found in Rajasthan. So if they're getting an extra 50 rupees a share, in my mind, that's almost like a free option that if you stay away for 3 years, that's enough time for them to, they can always come back. This is not a finite closed door on them. And from Cairn Energy's perspective, I think more of their attention and management time is needed on their Greenland exploration, which is pretty much what they seem to be talking about more at the moment. So I think it's a great deal again for Cairn Energy to actually have squeezed out this extra 50 rupees per share.
Absolutely. They're getting paid $50 to not compete when they were anyways not going to be competing over the next 3 years with Vedanta. Exactly. One final question. I do know that Vedanta shareholders may not be happy, just like you pointed out. But the other company's shareholders who are likely to be very unhappy is Sesa, because it's been dragged into this acquisition. The spare cash that was lying on its balance sheet has been spent. Additionally, Sesa will probably have to take on another $1 billion of debt to be able to finance its part of this acquisition, and that seems like a big burden for Sesa to have to take on. I know you don't strictly cover that, but can you give me your comment on how you think shareholders are likely to react to that?
I think again, generally, if you look at market reactions from both the credit market and the equity market, so Vedanta's stock, the share price is down relative to the sector about sort of 12% in relative terms. The CDS spread on Vedanta is at an all-time high for the year. So, irrespective of what I guess people think is a negative or positive, the market seems to be voting with its feet. And similarly with Sesa, the last I checked, it was down nearly 7% at one stage today. So I think from Sesa's perspective, this is increasingly more risky because you're at a very delicate stage where the government of Karnataka is banning iron ore exports. So there's quite a bit of uncertainty about Sesa's own volume, its own business model. It's a great set of assets, but we have a government issue here that, can the company carry on exporting iron ore to its Japanese and Asian customers? So with that in the background, you could say it would have been more prudent to make sure that Sesa stays with a strong balance sheet. It's still a strong balance sheet. It still doesn't have any net debt, but obviously the net cash buffer is gone. And it's also definitely a very valid question that if you bought shares in Sesa, did you buy it so that one day Sesa would own a minority stake in an oil company, or did you buy it because you wanted exposure to the iron ore price? And I think the answer is the latter, that investors in Sasagoa own it because they want to get exposure to the iron ore price, not because they also want a minority stake in Cairn India. If they wanted Cairn India exposure, they would have gone and bought Cairn India.
Well, absolutely. And in fact, I think last I checked their shareholding pattern, Templeton Funds holds about 13%. So let's see how institutional investors of Sasagoa actually react to this and whether they kick up a storm. Final question on India, and that is that if, despite all the objections and the skepticism that you've raised and other analysts have raised from across the community, this deal does actually in fact go through, what does it mean for the kind of debt levels that Vedanta will be taking on, and therefore the impact on its profitability, let's say over the course of the next 2 or 3 or 4 years, outside of the fact that it might impinge upon its own organic growth plan?
I think that's the real key question at the end of the day, because going into this transaction, Vedanta had about $3.7 billion of net debt at the PLC level. Taking on another $6.5 to $6.7 billion gets you to north of $10 billion of net debt. And you contrast that with analyst EBITDA forecast for the year at March 11, I think you're uncomfortably close to the covenants that the company has disclosed, which is around 2.7 times EBITDA. So I think that's the real issue, that post this deal, Vedanta becomes one of the most leveraged companies that we have currently under our UK mining coverage. So you have most mining companies that came out through the cycle have delevered hugely. Rio Tinto's under 1 times EBITDA, BHP Billiton's net cash. So Vedanta has gone from a position of relative strength, I would say, in this respect, to one of relative weakness, because while if you do have a double-dip recession, I think most of the mining companies are in extremely good health to actually endure that. But with Vedanta, it's probably one of the few companies that would be in worse health compared to when we went into the financial crisis. So I think that's really the big moot point, that I'm sure you can explain the deal if you wanted to, but the risk that's being taken on to actually justify the deal is probably where there's some frustration amongst analysts and investors.
All right. Thank you, Anindya, for painting a fabulously gloomy picture for this transaction. I'm sure we'll have more reason to come back to you over the course of this week as we hear more from Vedanta as well as Sasagoa and their shareholders. Thank you very much for your time, and thank you for joining us. And that wraps it up on this edition of Your World at 10. Thank you for watching. Stay tuned to CNBC TV 18.
We are buying the company overseas, buying the overseas PLC, which is the Cairn PLC, is selling the share to Vedanta PLC. And in that process, whatever is required, we are looking as an overhaul vision, as a vision to take India in a different level, where we have a 70% oil we are importing, and right from beginning we hear that every year we always believe that we are deficit on the oil. We find such a huge reservoir of oil in Rajasthan. Cairn is not an operator. They have discovered this oil reservoir and they have no experience on the operating. We have been operating other mining asset. We are supporting, and we have couple of fold increased the production. If you look at our, two things has happened. One is that India has a tremendous natural resource. And most of the business was with the government. Government believe whether it's an airport or an infrastructure or the natural resource has to be partnership with the private sector so they can accelerate and pace with the world. And that was the spirit, and that the same spirit will continue. And in that process, what we have bought and whatever the necessary of the taking the permission, we will follow.